Okay, hi everyone. Welcome to today's webinar session. We're gonna give about 2 more minutes to let more people join the session before we get started, because I can still see a bunch of people coming in. So yeah, we'll begin in about 1 more minute. So yeah, in the meantime, let me know if you guys can see me and hear me. Feel free to grab yourselves a drink, make yourselves comfortable, and I'll see you guys in about 1 more minute. Thanks, everyone. Okay, let's go ahead and get started. So, welcome to today's session. Today, we're talking about trading psychology. Um, as per usual, before we get into it, a disclaimer and a risk warning. So, our products are traded on margin and carry a high level of risk. It is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so here's our agenda for today. Firstly, we're going to talk about what exactly is trading psychology, and then revenge trading and how to overcome it, setting targets, and how to have a trading plan. So let's get started. So what is trading psychology? So trading psychology basically refers to the emotional and mental factors that influence traders' decisions and behavior in the market. It encompasses aspects such as discipline, patience, emotional control, and the ability to manage risk effectively. So, how do you overcome your emotions? So that we've put together a checklist, or rather kind of a guide of things that you should do so that it helps you to maintain your composure when you're trading. Yeah, and prevents you from revenge trading. Okay, so there are few mistakes that especially beginner traders might make that will lead to revenge trading. Firstly is not having a trading plan. So having a trading plan is important for several reasons. Firstly is consistency. So a trading plan helps you to maintain consistency in your trading approach. It outlines your trading strategy, including exit and entry criteria, risk management rules, and position sizing. So by following a well-defined plan, you're less likely to make impulsive decisions based on emotions or market noise. Consistency is crucial for long-term success in trading. Next is objective decision making. So a trading plan also provides a framework for making objective decisions. Helps you to define specific criteria for entering and exiting trades based on technical or fundamental analysis. So this eliminates guesswork and emotional biases, allowing you to make rational decisions based on predetermined rules. Risk management. So a trading plan incorporates risk management principles that help you to protect your capital, outlines how much risk you are willing to take on for each trade, where to set your stop loss orders, and when to take profits. Focus and discipline, that's pretty straightforward, and evaluation and improvement. So a trading plan helps to serve as a reference point for evaluating your performance, since you are continually keeping a record of your trades or and comparing them to your trading plan. And lastly, confidence. So confidence can really help you with your trading psychology, especially a well-defined trading plan, which gives you confidence in your trading decisions, since it provides a structured framework and a set of rules to follow, which helps you to reduce uncertainty and anxiety. Basically, when you have confidence in your plan, you're more likely to stick to it during challenging market conditions and avoid making impulsive or emotional decisions. So the next mistake that people make when it comes to your trading psychology is not having a stop loss. Okay, so to basically before we get started on where you should place your stop loss, let's first look at the anatomy of a trade, or what a trade consists of. Okay, so we have the obvious entry stop loss orders, take profit orders, and then we have the break even, partial profit, idea and validation, trading stop, and diversification. So it's super important for you to have proper trade management strategy in order to help you with your trading psychology. And there are a couple of reasons for this. Firstly is control risk. Trade management strategies such as stop loss orders and position sizing helps traders to limit their potential losses and manage their overall risk exposure. Next is to maximize profits. So you want to make sure that you can lock in your profits and maximize returns. Managing emotions. So the discipline and the structure that trade management provides can help traders to stay calm and rational even in volatile markets, which can prevent impulsive decisions driven by fear or by greed. Next is improve trade efficiency. So by having a well-defined trade management plan, traders can make faster, more efficient and informed decisions and avoid the cost and time of having to constantly monitor and adjust their positions. And lastly, increase consistency. So effective trade management helps traders to achieve consistent results over time by reducing the impact of individual losses and maximizing the impact of winning trades. Okay, so now let's look at a couple of examples. So if we look at this example, the red area shows a strong resistance since there have been two swing high levels in line with this area. So if our trading strategy requires us to have a fixed take profit of 100 pips, we would place the target beyond this strong resistance area. Okay, so let's see how this plays out. So price shot up. It actually missed our profit target by a few pips before reversing back down. Now, in an alternative scenario, if we had placed our take profit slightly before the key resistance level, we would have gotten a profitable trade. So the lesson here is that it's important to look at the charts and adjust your take profit and stop loss accordingly, instead of just following a forum that tells you to place a take profit 100 pips from your entry. Okay, so the proper stop loss and take profit placement is as such. If we are going in for a sell entry, in this case, you place your take profit above the major resistance area and your stop loss level above the major resistance area as well. Okay, so yep, here is the explanation for that. So here we're talking about Fib confluence, which is Fibonacci confluence, which is basically when two or more Fibonacci levels line up in the same area. But this applies for resistances, key resistance areas, or key support levels, not just Fibonacci levels. So you want to place your stop loss beyond a key Fibonacci confluence area. And the reason for this is because more often than not, price is attracted to such strong areas of Fibonacci confluence. And if your stop loss is right before instead of beyond it, you will most likely get stopped out before the market reverses. And this is one of the reasons why most people wonder why they got stopped out right when the market starts to reverse and start complaining about stop hunting. Now for take profit, we typically recommend you to place it before, which means that you should always place your take profit before a key Fibonacci confluence area or key major resistance area. The reason for this is because when price reaches the Fibonacci confluence area, there's a high chance that it will not be able to go beyond it, and instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. And this is also one of the reasons why people complain that the market is being manipulated, because they miss the take profit by 1 or 2 pips. So if you take a look at the image that we've included, in the previous slide, we looked at a sell entry. Let me just, previous slide, we looked at a sell entry where your take profit is below. Now in this image here, we are looking at a buy entry. So you can see that price is, we are putting our take profit above the entry since it's a buy entry. And in this case, we would place our stop loss below, take profit below any Fibonacci confluence or major resistance area. Do you guys have any questions so far? Okay. If not, let's continue. So here's the problem with a fixed stop loss. Here we have a support level with two swing lows in line with one another. Price has bounced off this support level, and we are expecting it to continue to rise to the swing high resistance. Our stop loss of 100 pips is fixed at the 1894.75 level at the support. So here price goes down instead. It touches. Yep, so when I say two Fibonacci confluence levels, okay, let's just go back. Oh, actually, why don't I show you? Okay, so if you're new to Fibonacci, you can take a look at this website. That's the forexarmy.com, but I'll just pop it in the chat. Okay, for this guide, this is a Fibonacci guide. And basically it goes through the different types of Fibonacci techniques. There are a bunch of YouTube videos for you as well. But the point that I wanted to show, yep, so it goes through the different Fibonacci levels, what to look out for. Yep, so what I wanted to talk about was Fibonacci confluence. So Fibonacci confluence is essentially combining multiple Fibonacci levels, So it can be retracements or yeah, it can be retracements, extensions, projections, and these is to find clusters where these Fibonacci levels congregate. Okay, because that area where they congregate would pose a strong level to play a trade from. So for example, if we look here, oh, why is it so small? Okay, let me see if I can find a clearer. Okay, here. So for example, in this image, we have Fibonacci conf three Fibonacci levels. We have one Fibonacci retracement, this 50%. Here we have a Fibonacci extension, which are the levels above 100%, which is represented by this green arrow, 241.4, as well as this 127.2 level. And they all line up in the same area here. So this area is what we call a Fibonacci confluence area, since we have more than two Fibonacci lining up in the same area. Yep, so that's all it means. But what makes it so significant is that price is likely to bounce off of that area. So confluence areas tend to attract price to it, but not necessarily because of the resistance in that area, price might not be able to surpass it. So we typically would expect it to bounce off of it or um reverse off of the level. Yeah. Okay, I hope I answered your question. But yeah, you can go ahead and take a look at this website if you're new to Fibonacci techniques. Um, yeah. Okay, let me get back to my slides. Feel free to let me know if you guys have any other questions as well. Okay. So from this example here, right, we buy thinking that price is gonna move upwards, but in fact, what happened is that price goes down instead and touches the stop loss and bounces perfectly from the stop loss. Okay, the reason for that, as I mentioned earlier, is that price tends to be attracted to key levels of support or resistance and it will bounce off of them. So what we should have done instead was to place our stop loss slightly beyond the key level of support or resistance so that we are not stopped out at the support, as price tends to be attracted to key levels of support and bounces off of them. So that brings us to our next point, which is dynamic stop loss placement. So dynamic stop loss placement is a trading strategy used to manage risk in which the stop loss level is adjusted dynamically based on market conditions. So the level of the stop loss is continually moved to a more favorable position as the price of an asset moves in the desired direction. The goal of the stop loss is to lock in profits while minimizing potential losses. And the placement of the stop loss can be determined by various technical analysis indicators, such as volatility or market trends. So here is an example. So you can see price has bounced off nicely off the support level at 86.721, and we're expecting it to reverse off the entry at 87.819 here, in line with the 100% Fibonacci projection level. Okay, over here you see we have another two Fibonacci's. So we have the minus 27.2 Fibonacci expansion and the 61.8% Fibonacci projection. And that lines up with our stop loss. Okay, so that lines up with our stop loss, and we're expecting price to bounce off of our entry and head towards our take profit. So as we mentioned earlier, the stop loss should be placed beyond the Fibonacci confluence area instead of before it, which is why we're placing it above. And we would have been stopped out if our stop loss was placed at exactly at the Fibonacci confluence area. Okay, so price reversed off and perfectly headed towards our take profit. Okay, so now let's take a look at another example. So in this example, we expect price to bounce off of our entry at the 87.625 level. And it's in line with a 78.6% Fibonacci retracement. So here you see price hit our entry and has reversed nicely off of it, heading towards our take profit. Take profit is 78.6%. Fibonacci retracement that lines up with our take profit. Okay, price just touched our take profit before reversing off of it. That's the reason why we place our take profit before the swing low support. Okay, because if we had missed this, we would have gotten stopped out over here. Okay, now this example, in this example, we are looking at a descending trend line. Okay, so what makes a descending trend line valid trend line is if we have at least 3 touches on the trend line. Here you see price has broken out of the trend line, which is giving us a bullish signal. Okay, we have our minus 27.2 Fibonacci expansion and our 127.2% Fibonacci extension that all line up with our take profit. And our take profit was placed above or beyond the confluence area. Price reversed off of it and missed our take profit by a few pips. Which is why if we had placed our take profit below the confluence area, price hits our take profit nicely before reversing back down to our entry. That's why we always recommend you to place your take profit before instead of beyond any key levels. Okay, any questions so far? So just give me a second. Okay, if there are no questions, let's continue. So the third common mistake that people make that might contribute to your trading psychology or the lack of trading psychology is having no risk management. But we'll touch on this in a little bit. Next is chasing losses. At what point is it good to adjust a stop loss to entry? Is there a particular strategy? Yep, so I'm just getting into this right now. That's a really good question. So Chasing losses, also known as revenge trading, happens when you let your emotions cloud your judgment. And this happens even more so when you don't have a proper trading plan. Okay, so now I'm gonna talk about some of the techniques that you can use to prevent chasing losses, and prevent revenge trading. And some of these also talk a bit about adjusting your stop loss level to an entry. So firstly, we have a break even. So break even in trading refers to the point at which in a trade, or rather a trade reaches a level where the trader has neither made a profit nor suffered a loss. It's the point where the cost of the trade, including fees and commissions, is equal to the price at which the trade was executed. So this helps traders to determine the minimum price that they need to sell their trades in order to cover their costs and avoid a loss. And this information can be useful in deciding when to close a trade and take profits or cut losses. So here's an example. Break even is a level where you are in profit and recognize that there is a risk of reversal. Here we have an entry at the breakout of the multiple swing high resistance over here. So we're going in for entry at the blue dotted line, and we are hoping for price to push towards our take profit. So you want to take note of our original stop loss at the point at point 2 over here at the stop loss. And it's also in line with our swing low support. At point 3, price reaches our break-even level and reverses off it. Hence, we move our stop loss to the entry to protect our position. If price continues to our position, that's great. But if it reverses back to our entry, we want to be protected. So here we can see price has broken above the break-even, but quickly reversed and hit our stop loss. So we got out of this losing trade at the break-even. Okay. Okay, now let's look at another technique, which is partial profits. So partial profits refer to the practice of closing only a portion of a trade when it reaches a certain profit target, while leaving the remaining position open in order to potentially capture further gains. The idea behind partial profits is to lock in some of the gains while giving the remaining position room to potentially continue to move in the desired direction. So partial profits are typically used when there is a strong resistance area and you're unsure if price will rise to your take profit. That's typically how we use partial profits. Okay, the example that I have here talks a bit about stocks, but the concept is similar for Forex as well. Okay, now let's take a look at an example. So firstly, in this example, we have two Fibonacci levels. We have the 38.2% Fibonacci retracement that's in line with a 78.6% Fibonacci projection. So we're expecting price to rise to our take profit, but there is a strong resistance at the Fibonacci confluence area. Okay, so here we see price reacted off the strong resistance area and our partial profit and reversed off of it instead of heading to our take profit. Okay, so next break-even placement. So in this next example, we have a 100% Fibonacci projection in line with our entry. And we are expecting price to hit towards our take profit. expecting it to bounce off and hit towards our take profit. Okay. Here we also have a 23.6% Fibonacci retracement, as well as a 38.2% Fibonacci retracement. And that level, we've labeled it as our break even. Okay, so we're expecting it to reverse off and hit towards our take profit. And here you can see it did reverse off our entry and it is heading towards our take profit. Okay, so once price hits our break even, we adjusted our stop loss to move it to our entry in order to minimize any losses. And you can see here it's a good thing that we did because then we got out at break even. Okay, any questions so far? Okay. Um, okay, so if there are no questions, let's move on. We have another trading strategy. So we are going through quite a number of trading strategies today for today's webinar. So if you guys are unsure about anything, just feel free to let me know in the chat. So our next trading strategy is called idea invalidation. So for idea invalidation, it's basically the point in which it's placed before your stop loss, and it's the level which you admit that you're wrong and then you want to get out of the trade. So when this level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. So at your entry, in this example, we are going in for the entry over here at the blue dotted line, going for our sell entry towards our take profit. But over here, you can see price actually reversed and hit it back towards our entry. So once price hits towards our idea invalidation level, we place our take profit. So earlier on for our break even, we moved our stop loss to our entry. Now we're moving our take profit to our entry instead. Okay, so that it gets us out of this losing trade. So what exactly it is, it's basically the process of evaluating a potential trade idea and determining if it should be disregarded or acted upon. So essentially, it's a way of determining if a trade idea still holds up in light of new information, such as economic data, market conditions. And here's how the process of it typically works. Firstly, we have the initial trade idea. So like earlier you saw, we placed our trade, our take profit, stop loss levels, and entry first. And then evaluation of the idea. So the trader then evaluates the idea by looking at current market conditions and other relevant data, such as economic data, to determine if the initial trade still holds up. Invalidation criteria. So in the previous example, our invalidation criteria was that horizontal level, was this purple horizontal level. So if price hit this level, we would move our take profit over here. So that's the criteria. And monitoring, so the trader continues to monitor the market and the security in question to see if the invalidation criteria are met. If the invalidation criteria are met, the trader may choose to exit the trade or adjust the position. On the other hand, if the criteria are not met, the trader may continue to hold the position or add to it. So in short, idea invalidation is a crucial step in the trading process that helps you to make informed decisions about your trades and avoid potential losses. So let's look at a real example now. Here we have a 50% Fibonacci retracement that lines up with our take profit. Okay. Then we have another retracement, 50% retracement that lines up with our take profit. And we also have the 127.2 Fibonacci extension and the minus 27.2 Fibonacci expansions that line up in the same area at the bottom. Okay, and here you see price we're expecting price to bounce off of the entry and hit towards our take profit. And we're placing our stop loss beyond that key Fibonacci confluence area. So in this case, we are placing it below it. And we're placing our idea invalidation at that level. So our criteria now is that if price hits our idea invalidation, we will quickly move our take profit to that level. Okay, and you can see exactly what it did here. It didn't go according to plan, hit our idea invalidation, and so we move our take profit to our entry. Okay, so that we can get out at break even. So these techniques help you to prevent getting emotional or prevent revenge trading, which might lead to even more losses. Okay, so it's a good thing that we moved our entry, take profit to our entry. Otherwise, we would have gotten stopped out here. Okay, so our next technique isn't so much of a technique, but it's more of a type of stop loss. So for trailing stop loss, it's a type of stop loss order that is set to a percentage or dollar amount away from the market price. The idea behind a trailing stop loss is to lock in profits while giving the trade room to breathe, as the stop loss follows the market price as it moves in favor of the trade. Yeah, so you can take a look at the example that I've given. Again, this is in the context of stocks, but it still applies. So the trailing stop loss technique can be useful since it allows traders to manage risk, lock in profits dynamically as the market moves. Okay, so let's look at some examples of a trailing stop loss. First, we have the moving average, parabolic star, chandelier, ATR, support and resistance levels, and a combination of these methods. So let's take a look at some examples on how it works. So firstly, we have price moving in an ascending trend line, but it's currently breaking out of the trend line. So that is our first sign, or rather our first bearish signal. Okay, and that's also our sell entry. So as price continues to move, we realize that it's moving below the moving average, which is a bearish signal. And once it actually hits the moving average, or surpasses it, that is when our trailing stop loss is triggered and we get out of the trade. Okay, so it's a good thing that we got out of the trade because we would have made a lot of losses over here. Okay, next let's look at our trend line breakout. So price is moving in a descending trend line. Again, what makes a valid trend line is if there are at least 3 touches. And once price breaks out of the trend line, then our trading stop loss is triggered and we get out of the trade. Next, for parabolic SAR, same concept, price is moving below the indicator, which is a bearish signal. Once it surpasses the indicator, then we get out of the trade. So I think by now you guys kind of got the hang of it or the idea behind it. So chandelier stop loss, it's the same concept. Price is moving below it. Once it moves above it, we get stopped out. And MA as well for this example. Okay, we get stopped out here. And for this example as well, okay. So using breakouts as trailing stop loss, are some of the examples were what we did earlier. So breakouts are usually high volatility events. Price can spike up and reverse almost as quickly, and a stop loss can help you manage risk, protecting capital. Trading stop loss can help you to protect your profit. Yeah, I'm gonna move on to our next point because we are running out of time. But all of these are basically what we've mentioned earlier. Okay, over trading. So you have to trade to make money and not trade for the sake of trading. This is part of trading psychology because oftentimes if you are trading for the sake of trading, it'll lead to even more losses. Next point is a common mistake that you would make is ignoring fundamentals. So I'm going to very quickly go through this as well. But basically, what is an FX news calendar? Um, It basically allows traders to see at one glance all of the important economic data releases, showing you key events such as GDP, CPI, NFP, crude oil inventories, and even central banks' monetary policy meetings. So on the left, we have investing.com, and on the right is forexfactory.com. So these are just some examples of economic news calendars that you can use just to keep yourself updated on the different economic data releases that's happening around the world, because those also impact the market. Okay, I'm gonna skip some more slides. But let's basically just look at what exactly some of these high impact events mean. So FOMC meetings for the US, it's the US Fed's way of communicating their view on monetary policies. The Fed interest rate decision normally comes together with these FOMC meetings. And yeah, NFP measures the change in citizens that are employed from the previous month, excluding the farming industry. And unemployment rate measures the total unemployment of workforce that is seeking active employment from the previous month. Crude oil inventories, these measure the weekly change in the amount of crude held by US firms. And if crude oil inventories increase, then oil prices should drop. EIA is the monthly forecast for the year ahead, demand and prices across major fuel types. And yeah, here are some benefits of using an FX calendar. Okay, lastly, why exactly you should have a trading journal and how you can set up your trading journal so that it helps you to keep your trading psychology in check. So firstly, you want to choose a format. So this can be in the form of an Excel sheet or a written journal, or a digital document or a software. It's entirely up to you. And next, you want to decide on the categories. So define the categories of information that you want to include in your trading journal. Some common categories are date and time of the trade, the trade symbol, entry and exit prices, position sizes, stop loss and take profit levels, trade duration, and trade outcome. You can also include additional categories such as your trade rationale, market conditions, as well as your emotional state. Next, you want to capture trade details. So record the relevant information for each trade that you make. You want to make sure that you are diligent and consistent in entering the details as accurately and promptly as possible. Include all the predetermined parameters, such as entry and exit points, as well as any adjustments made during the trade. Analyze trade performance. So you look for patterns, trends, and areas for improvement so that you can understand why successful trades worked and why losing trades fail. Okay, and next is to reflect on your emotional factors. So it's important to take note of your emotional state during each trade, record any emotional biases, such as fear, greed, overconfidence, that may have influenced your decision making. So this information will help you to become more aware of your emotions and develop strategies to manage them effectively. Review and adapt. So regularly review your trading journal and make adjustments to your trading strategy as needed. Maintain discipline. Stick to the discipline of recording each trade and consistently updating your trading journal. Okay, here are some benefits. And yeah, I think that's all from me for today's session. Do you guys have any questions? Hey, Mohammed, thanks so much for that and for attending today's session. Thank you to all of you guys too. Yeah, I hope you guys found this session really helpful, and I will see you guys again next week. Thanks, everyone. Bye. Have a great rest of your week.